The Canadian mortgage landscape is about to get a facelift. Yeah, facelift. Last week, the head of OSFI, which is the Canadian banking regulators, is effectively just proposing a more stringent mortgage lending guidelines, right? So here's what you can expect based on, I guess what they announced last week. I'm gonna break it all down for you in this week's video. Now, if you are looking for some help on how to navigate this real estate market and get a better understanding of what all these changes may mean to you as a person who's either buying, selling, or investing in the Toronto real estate market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and the time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a Remax in the Greater Toronto area on top of making awesome educational real estate content just like this one for you. Now, last week, the head of OSFI, I'm going to get this right, the Office of Superintendent of Financial Institute, I think that's right, which is like the Canadian banking regulators, announced that they plan to tighten the mortgage qualification for most Canadian homeowner buyers. Now, when I say most, it's because some of their policies aren't regulating certain lending institutions, but I'll get more about that later. Now, they have a few considerations that, they're, I guess, talking to surveying other professionals that they're considering changing, but they're just trying to get their thoughts on it before they kind of go ahead. So I'm going to go over what potential policy change could be and how it's going to impact you and what it's going to mean for the mortgage lending landscape. And then, as usual, I kind of give you my thoughts about all this afterwards. But before that, real quick thing for anyone who's kind of like a Family Guy person, this is what really grinds my gears, okay? It's our government is always so behind the 8 ball. It's ridiculous. And I've talked about this many, many times in 2021 about, hey, look, why don't you just restrict the mortgages for investors and reduce the demand that way? Very simple. You could have just increased the down payment from 20% to 30, 35, even 25% would have made a difference. But nope. And now that we're in a down market, here comes all the more restrictions. Just silly. This is just like how they're taking credit for the market slowing down. And just when the market was turning in February 2022, that's when the interest rates increased. Or that vacant home tax is now a thing when the market is slower. Or the foreign buyer ban, right? Again, I can list many, many things, but always too late. But again, rant over. So here are the considerations OSFI is contemplating, okay? Number one, the new restrictions on mortgage size and debt loads. So what OSFI wants to do here is restrict the number of borrowers, people borrowing mortgages, at each bank to have no more than a quarter of their mortgages greater than 4.5 times the gross income of the borrowers. Now, that may sound like a mouthful, but let me kind of give you some context of what that means. Currently, you could borrow roughly 5 times your gross income. It's kind of been that way since 2018 when the stress test came in. Now, obviously, with the rates a little bit higher, it's close to like 4.5 times because of the qualifying rate. Now, why this 4.5 times and 25% of the book, right, is important is because there have always been exceptions at the banks that are granted to the borrowers, the people who are asking for money. This is why a good mortgage broker is key because they know how to wiggle around that stuff. But there are many times when a borrower generally goes over the 5 times rule, but OSFI wants to restrict these exceptions because I think there's a lot of these exceptions. And one of the things that I will note is that in 2018, when the stress test rules first came out, they were, I guess, followed stringently at the time. But after a few months, I noticed it got a lot looser with a lot more exceptions, right? So to me, this sounds like OSFI wants to reset a lot of the amount of exceptions at each bank and make it more stringent for them to not provide these exceptions and restrict the number of it so that the banking system is a little bit safer. But is it going to loosen up later if they implement it? Who knows, right? I don't know because this is all behind the scenes stuff. The second one that they're contemplating is the debt service coverage restriction. So there's this thing called GDS. If you got a mortgage, you probably understand, which is generally gross debt servicing ratio. And this is what this consideration is talking about, the GDS. So normally when you go get a mortgage, again, normally is the word, normally, you're not allowed to go over 39% of your gross income for servicing your house. Meaning, say you make 100 grand, you shouldn't be using more than 39% or $39,000 towards housing, or which is around $32,000 a month, which sounds like very, very little, which is true right now. Now, of course, like the first one, there are always exceptions, right? A certain red color bank I know doesn't use maintenance fees in their GDS ratios. So condo buyers generally qualify for more mortgage with them because they don't include that debt. Now, the thought consideration here that OSFI is trying to do is put a hard cap at the 39%, not a soft cap. So if you're a sports person, you understand. Meaning that no exception is to get around the stress test of 39%. Now, as a side note, again, to provide you some more color, I've seen GDS over 45% before when people are getting mortgages, right? Number 3, the interest rate affordability stress test. So the banking regulators want to say they want to implement a new minimum interest rate for the stress test. So does this mean increasing the qualifying rate, which right now is like 5.25%, or whichever is larger, the contract rate plus 2 or the 5.25? Now, they didn't specify what they plan to do with the minimum interest rate. They just say they want to change it for a specific type of mortgage, which kind of like, a duration of 1 year, 2 year, 3 or 4 year, 5 year, variable or fixed. They want to change it so that it matches the mortgage you're getting. They also said they want to prevent the shock of loss of income, due to like losing a job, a divorce, or interest rates going. So how they plan to do that, I have no idea. They didn't even say, right? So this number 3 thing sounds like a very open-ended conversation to me, or consideration. So who knows? Now, if you found this content useful, it probably means some other people will as well. So make sure you smash the like button and help share this with other people so that they understand what the heck is happening in the real estate market, specifically the mortgage lending space. And while you're at it, make sure you subscribe to the Prime Props channel. And then again, if you are looking for some help on how to navigate the real estate market in 2023, you can book a call with me using a link that's right here. It's www.chatwithzen.com. So now that you kind of understand 1, 2, and 3, kind of like their potential policy changes, here are kind of my thoughts on all this. I personally actually welcome these more like stringent mortgage rules. Now, despite me being a real estate investor and all these new rules make my life a pain in the butt when I try to go get more mortgages for more investment properties, I am personally a big fan of this because it makes our financial system stronger. It prevents us from having a US 2008 style type of crash where you had the ninja loans were given out. And for you guys who don't understand, ninja stands for no job, no income, no asset application, right? Now, are these coming a little bit too late? Yes, 100%, like I said in the beginning. But, it's Canada. Now, a lot of these kind of like announcements remind me of the 2017-2018 crazy market where we had a huge run-up in prices, in the late 2016 leading up to April 2017, which is similar to what we just saw in December 21 up to March 2022. And after the 2017 run-up, OSFI started getting more stringent about the mortgage rules, which is what led to the 2018 B20 stress test that we're all accustomed to right now. So does that thing kind of sound familiar? Because if it does, it's the current playbook that we're seeing right now. It's just that we're pulling it back a few years. So one of the things that was touted a lot before the new stress test was implemented in 2018 was there was like a really huge spurt of people towards the latter half of 2017 that wanted to go buy something so they could still qualify before the turn of the calendar where they couldn't qualify anymore. Are we going to see something like that? Maybe. I don't know. It's still a little bit too early. Now, that's just kind of what happened, but I still think we're a little bit too early for all of this right now because, again, the policy hasn't really officially come out. They're just kind of testing the water, dipping their toes in the water. We'll probably see some more stuff in like latter half this year, call it June, and then from there it has to be implemented. Now, my final thought though is this. If you want to go around these banking regulator potential rule changes or even the stress test, you can always go to a credit union. The rates are a little bit higher because they're not regulated by OSFI, or, the usual just add a family member to the application, which is what most people have been doing if they, really, really wanted to stretch and get a mortgage for, the new home that they bought, or if they can't qualify. So technically, that does put, an order of magnitude of stress in the financial system if you just add a family member to title. But I'd like to kind of see them try to address that component of it because that seems to be very rampant. But I will say that the idea obviously is trying to prevent as much people from, stretching beyond their means to get a mortgage so that, it makes our financial system shock-proof and safe for the, entire Canadian landscape. I tend to agree with them with that. And, bravo, hats off. Please continue doing that. And I really do think that OSFI should be giving some additional credit, even though a lot of people don't like them, for the stress test that they implemented. Because while it wasn't perfect, I would say it did help put a lid on how catastrophic the 2022 crash could have been. That's a wrap. You let me know in the comment section below if you agree with my thoughts on what I think about OSFI's upcoming increased scrutiny from the mortgage borrowers. And again, if you're looking for some help on how to navigate this real estate market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya! Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.